Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And this morning, things are a little different than the past couple of weeks in terms of how markets are currently trading. So we want to talk a little bit about what shifts we have seen here in the broader markets and how we are adjusting our portfolios for that. So before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So let's start off with a broader view here. We're going to talk a little bit about seasonality. We'll talk about seasonality both from a longer term 6-month period, but also in terms of May, because I think that's going to help set up some of the conversations around some of the shorter term momentum and shifts that we have started to see here in the broader markets. Then we'll take a look at the major indices. Surprisingly, we have seen quite a bit of a shift here from the major indices and how they've seemingly all have lined up a little bit after being fairly, I would say, a fair amount of rotation within the different indices. Then we'll take a look at sector rotation, which we still see a fair amount of healthy sector rotation. So regardless of whether you have bullish or bearish views here in the broader markets, you're likely going to be able to position well within certain sectors that may perform both on the upside as well as to the downside. I do want to review commodities here as well, because we see a lot of risk assets amongst commodities all trade very similar with each other. And that's always a risk that we currently see in the broader markets. Take a look at some of the economics before we share with you our ideas here for today. But the primary question that I want to help investors walk away from today's session is a continuation of what we discussed last week, but we have seen some evidence of a shift here between last week and this week. And that's, are we finally seeing signs of a potential market pullback based on the market conditions that we see here today? So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And I want to share with you my technical research, seasonality research, economic research, and the views that we have in the broader markets that help us inform our trading decisions. So we'll start off with some seasonality analysis, because you might have heard a saying called sell in May and go away. And this comes from the fact that May through October, out of any 6-month period of the S&P 500, is the worst performing period of the year. But the one thing that I want to explore here is the fact that the average return during the 6-month period is still positive. So it's not exactly true to say sell in May and go away. The median return is still 3.1%, and it is up 65% of the time, which is on the lower end of the spectrum. As you can see, the average is about 66%. Whoops. The average is about 66% of the time the markets are up, and this is basically up 65% of the time. So pretty much on average in terms of how often it is up. So this is really one of the things about that sell in May and go away is incorrect. However, if you look at May itself, May is not a particularly strong month out of the S&P 500. It is on average down about 5 basis points. So May as a month, out of the only 3 months out of the year, between February, May, and September, are the 3 weakest months out of the year. But it's not a particularly bearish view, I would say. It's simply more of a neutral view. 58% of the time the markets are up in May, on average of down about 5 basis points. Very similar to what we saw in February. And September is really the worst month out of the year. So this helps set up, just from a seasonality perspective, what May looks like going into May. It's not a particularly strong month, and that's part of where I think the saying sell in May and go away, that idea comes from this type of seasonality analysis. But I will say there is a caveat to that, and that is the fact that during year one of a presidential cycle, from 1929 to present, May has actually been a fairly strong year, a strong month during the first year of a presidential cycle. It's actually up 60% of the time, average move of about 2%. So as you can see, there's a pretty big dispersion between the average May months versus the first year of a presidential cycle. So we have to take all of this information with a grain of salt. First of all, the first year presidential cycles from 1929 to present, there's only a few, the sample size of that is pretty small. So the smaller the sample size, the less reliable this data is, and the more you have to take it with a fairly sizable grain of salt. As far as every single May from 1928 to present, there's quadruple the number of sample size. So I would put a little bit more weight behind this graph than this graph. So this is just, again, this is not a seasonality because we're talking about a fairly small sample size, even in every single year from 1929 to present. We're still using this as just as a way to help frame the bigger picture. So with that, let's take a look at the broader markets. Let's take a look at where markets are today. Now, here's where we just see classic signs of exhaustion pretty much all the way around. If you look at the weekly chart here, we've now reached a new all-time high, and momentum is now reached overbought. Now, one of the big signs of exhaustion here is the fact that markets have made a higher high, but has still failed to make a higher high on momentum. This is from February of last year through April of this year. And if you look at the charts here, as markets on the daily chart, as stocks continue to make higher highs, we are now making lower highs on momentum. So we are starting to see signs of exhaustion, and this certainly starts to put into a higher probability of a pullback here. Now, the question is how big of a pullback? Now, when we look at the evidence here on the broader markets, I don't necessarily see convincing signs of a big pullback here. However, there are some of the things that we brought up here over the past few weeks with respect to signs of inflation, signs of supply chain issues, that is the potential catalyst that could weaken this recovery even further. And those are some of the things we're going to explore here today in our economic section. So SPY on the daily chart, on the weekly chart, starting to see exhaustion. QQQ, same thing, higher highs on the weekly chart. We continue to see higher highs in the weekly chart with negative divergence on the weekly chart. So the larger this divergence is and the longer it goes on for, the higher the probability of a bigger pullback or more violent pullback here. On the daily chart, as you can see, higher highs, not confirmed by higher highs on momentum. So this also, accounts for a potential pullback here in the tech shares in the NASDAQ 100 index. When we look at IWM last week, we talked about a potential breakout here to revisit those all-time highs. That has failed that breakout, and we're now back inside of the trading range. And you start to see what looks like a bit of a topping formation almost starting to form here on IWM. So small caps also showing a little bit of weakness here, not quite weakness enough, but at least certainly enough to revisit 215 support and potentially 210 support here to the downside. So you really have the three major markets fairly lined up here in respect to markets are exhausted, markets are a little overbought, potential signs of a small correction here on the horizon. Now, again, that doesn't mean that we're set for a big correction, but we need to start paying attention to some of the evidence to see, are there some cracks starting to show in this recovery? If there are, how big are they, and which stocks or which sectors are most vulnerable? Now, when we look at the RSP, the equal weight S&P 500 index, this is the one part of the market that remains strong. So as we make higher highs on RSP, for the most part, momentum has confirmed those highs. They have not seen a lot of negative divergence. So this is the one area of the market that remains resilient here at the moment and continues to climb. But as you can see on the weekly chart, it is overbought. The daily chart has reached overbought many times over the past few months and continues to kind of grind its way higher here. And I don't know how much higher that can go or how much longer that can go on for. There are small signs of divergence here as it makes a higher high, momentum no longer confirming those highs, but that's not a particularly big divergence that I'm very concerned about. But overall, major markets have shifted a little bit in terms of tone over the past week with respect to price action. Now, whenever we talk about a potential correction here, this is something that we haven't looked at in a while because markets have not been this weak, is looking at the ratio of the 3-month VIX versus the front month VIX. When it dips below a ratio of 1, that's really the potential signs of a major market sell-off. That's what we saw here back in February of 2020 during the coronavirus sell-off here. We had a small dip here in late October, and this was mostly an intraday dip that we saw here in early February of 2021. But so far, it is still in what we would consider normal ranges. The 3-month VIX is currently at about 1.1 times the front month VIX. So we're not in type of that contango. We're not in this distressed market that typically would lead to a fast, violent, big pullback here in the broader markets. But this is one that we're going to start to watch again here, because if we start to see this pullback and start breaking below 1, that is the signs of a potential time where you need to hedge your portfolio. Right now, this is simply just more of a normal market correction or normal market pullback that you would want to see in a market that is effectively continuing to march higher here. Markets that continue to march higher, it's not healthy. You need to see consolidation. You need to see pullbacks in order for that rally to remain healthy. And so far, we haven't seen much of a pullback here. So timing wise, we are roughly in line due for some type of a pullback or consolidation. And if we look at EEM, also emerging markets have failed to break out higher here as well. So you really have evidence here, not only here from the domestic equity markets, but also from the international markets, that things are taking a pause. Things are slowing down. There's signs of exhaustion here. So when you look at the equity markets, that doesn't necessarily mean that you should go out there and short the markets. It just means that you need to be paying attention to where do you want to position within equity markets? And this is really where, value has continued to hold this major support level that we've been talking about. For those of you that have followed us here over the past few months, I've been showing this chart almost every single week, showing you that value has been underperforming growth. But over the past 7 months, value has bottomed towards growth and started to break out here and started to retest this level. So this is the breakout here of value to growth. It came back to retest this a couple of weeks ago. And so far, it has held that support level. So this is constructive again for value. So think about stocks that have performed well here over the past few weeks. Think about UPS, think about Walmart, think about CVS. This is something that I've been talking about for months now. Position yourself in value, be more defensive. The second we saw some of those high beta tech names sell off in beta, we were talking about being more defensive. We remain defensive this whole time. That is where you want to be at the moment with respect to equities. Value, smaller cap, has been strong, and it looks like will remain strong, especially since that this support level now has held as support, and we're now seeing value outperform growth. So as you're looking for the equity markets here right now, you want to position out of growth. You want to position back into value. This is something that we've been talking about for months. So when we look at the sectors here, sector rotation, energy has really taken off here over the past few weeks. We've talked about commodity prices. We're going to talk about oil prices here today, but energy continues to outperform here. We expect energy to probably lead for at least a little bit because crude pricing continuing to be strong here. Financials also just shy of getting into the leading category. Communications, I would say largely driven by Alphabet strength here this week. Industrials, these are the 3 strongest sectors moving into the leading category here to the upper right-hand side. You have real estate that has been strong, healthcare that has been strong, materials starting to all weaken here despite being strong for just a fairly short amount of time. And then you have consumer discretionary, technology, utilities really starting to become weaker here. Discretionary and technology is really 2 of the places that I would suggest staying away from right now, especially in this type of rotation that we're starting to see, especially if we start to see weakness. I expect that you're going to see further weakness from discretionary, from technology, real estate, healthcare, materials. Those are the places that I would start to look. And if you're looking for strength here, looking for value, staples, industrials, communications, financials, one of the biggest value sectors. Look at names like Goldman Sachs trading at 7 times earnings. But I would say on the industrial side, you do have a lot of names that are trading at fairly rich valuations. So be careful on the industrial side. You really have to be careful in terms of picking specific stocks on the industrial side when you're looking for stocks. And then communications also tough to pick value stocks in those types of sectors. So, but as you're looking for opportunities, make sure you're familiar with and understand this data. And if you are watching this, live, I recommend that you watch the recording before you pull the trigger on names. Make sure you review this information because it's very important that you position correctly in this type of market environment. So next, I want to take a look at the commodities because we've really have started to see the commodities trade all in lockstep. Risk assets are trading in lockstep, and we're starting to see some pretty extreme moves, I think is the best way to put it. And gold certainly on the lower end of this particular move here in terms of you have gold still in this down channel here, but starting to retest this upper resistance channel here. And the question is whether it breaks this upper resistance channel, because if you look at commodities as a whole, we're starting to see commodities become very strong here. If you look at crude recently breaking out above the $63 resistance level and now retesting 68 as an all-time high. Would that bring us into the 70s and potentially 80s? This is really something that we have to pay attention to. Now, I do think that OPEC may step in and perhaps increase supply if this does continue to increase by much. But this is really some of the commodity risk assets that are starting to trade at fairly extreme levels are starting to get to these extreme levels. And the one probably poster child of that is what we have seen. And it's not from Bitcoin, even though a lot of interests have been in Bitcoin here over the past few months. Ethereum really taking off yesterday, up about 10% on a single trading day, really reaching what I would consider very exhausted and parabolic moves. Just on a weekly chart here, notice how much the stock is the Ethereum coin has effectively doubled here in the past couple of months, despite making a higher high. Momentum no longer confirming those highs. We see that on the daily chart. We see that on the weekly chart. And the one thing I will say is that notice how these parabolic moves to the upside have been on declining volume. This is what we saw in Bitcoin here a few weeks ago, where I started to warn investors about that move up to that $64,000 level. Ethereum, very similar move, just a little bit more exaggerated, a little bit more parabolic. Because it's a smaller cap name, it tends to get manipulated even further. So when you see these types of parabolic moves in all risk assets like gold, crude, copper, lumber, all of these commodities are trading very similar to each other, and you're seeing the same patterns emerge. Higher highs without confirmations of higher highs for momentum, negative divergence on daily and weekly charts. These are all correlated assets that may have that opportunity of pulling back here. So this is some of the concerns that I have here across not only equities, but also, risk assets as a whole have just reached these types of extreme levels that are not particularly justified in my opinion, or at least we're starting to see signs of exhaustion on price action across the board. So this is the type of concern that I see. Now, the one thing I will say is that these types of signs of exhaustion and negative divergence, they can continue to go on for a period of time. They could go on for another few more weeks. They sometimes can go on for a few more months. The longer they tend to go on for, the longer they tend to go extended for and go parabolic for, the more violent, the more the rapid that sell-off that we tend to find. So, we've already seen in terms of earnings this particular season that many of the higher beta tech names have started to come off here. That's why I was bearish on Intel. That's why I was bearish on Netflix going into earnings. If for those of you that have been following me for the past year, I don't do a lot of bearish earnings plays. But this is the one quarter where I have predominantly done all bearish earnings plays because of the signs that we're starting to see, these slowdowns that we're starting to see, the signs of exhaustion, and the fact that stocks that are beating earnings, and we have seen a lot of major big beats here this earnings season, where the stocks have barely nudged higher. Think Apple, think Microsoft, think Amazon, all of these stocks beat earnings by a fairly sizable margin. Morgan Stanley, Goldman Sachs, JP Morgan, we're talking about substantially sizable beats, yet those stocks have barely nudged higher, if not traded lower after earnings. So the market is telling you something when we see that, and that's exactly why I've shifted my view here into the broader markets. And for those of you that have been following me for the past year, you know that I'm largely very bullish here in the broader markets, even when things are near overbought or near overextended ranges. Those are, I tend to find potential buying opportunities when you see that quick violent pullback here. This is more of a structural shift in terms of how markets are currently reacting and how markets are trading. It could resolve itself fairly quickly. That's one of the things that's the one tricky part about these things, is that it's really difficult to tell how far the markets are going to pull back. So we really have to pay attention to what's driving this weakness, what's driving the pullback here. And one thing that we started talking about here over the past few weeks is really the labor and supply chain pressures that we're starting to see here. And April ISM manufacturing, after having multiple almost a full year of just straight gains, have seen a pullback here in April. Survey was 65, came in at 60.7. A lot of it came because of employment issues in the manufacturing space, labor shortages across the board, supply chain shortages. This is starting to squeeze manufacturing. And manufacturing has been one of the major drivers of the economic recovery since May of last year. And the fact that we're starting to see manufacturing slow down. Now, services is picking up, right? So services is picking up some of this slack. But what we were hoping for is manufacturing to stay strong and services to then rebound. That's really where you have confidence in a strong economic recovery. But when manufacturing is starting to slow down as services starting to pick up, you really have the two kind of just offsetting each other rather than continuing to strengthen. And that's really part of why I think the equity markets, again, are taking a pause here and has the potential for some form of a pullback or some form of a consolidation here. So when we look for opportunities here in this market, I am skewing more towards the bearish side. Now, I do still think that there are bullish opportunities, like you've seen here in Walmart and Costco, in CVS and UPS, but value-based, names that are fairly low valuation. The banks still fall into that category. There are still names that I'm still looking for bullish positions in, but I'm also on a speculative, more opportunistic perspective, looking for more shorts. I think that's where you're going to see some more violence, some more quicker moves here to the downside. So the daily play for today, Etsy, is really one that we're paying attention to here. Similar type setup that I've seen all earnings season, where stocks trading near support levels here that have actually already broken down relative to its sector. So Etsy has already broken down relative to consumer discretionary, this support level here. And I think Etsy reports earnings tomorrow after the close. And I think it's an opportunity to potentially look for a quick move to the downside, just like we saw on Netflix, on Intel, and some of the other names that I have bearish positions here this particular quarter on earnings. And this is a stock that trades at 67 times earnings, where made sense when the stock was growing revenues 300%. But right now, revenues are expected to slow down to just 17% growth. That does not support a 67 times earnings valuation for a stock that is slowing down that heavily in terms of revenue growth. And largely, Etsy doesn't have a particularly strong future, if you will, meaning their business is largely the same as it was 2 years ago in 2019. They haven't diversified geographically. They haven't changed their business model. It's effectively the same business. And while they have benefited strongly from COVID and the work from home and people staying at home, as we reopen, this is going to slow down. And I think the valuations are going to come back to earth. So this is our daily play here for today. The next one is, I'm sorry, this should say this is incorrect in terms of the title, but this is Tesla. Tesla, I think, is going to likely suffer from very similar supply chain issues from some of the other car manufacturers, and simply, I think, has some downside here, especially after the earnings report that came out. Again, that was largely, in line with what markets were expecting, but the stock is trading lower here. Trading was rejected at the 21-day moving average here yesterday. I think has downside here into the 600, maybe 560 zone here, which is the 200-day moving average here to the downside. With a name like Tesla, I wouldn't buy a debit spread like I would here in Etsy because I'm expecting a catalyst move here, right? I'm expecting a potential event that's going to drive the stock potentially significantly lower. That's where it makes sense to buy a debit spread. But on Tesla, I'm expecting that this would be a slower grind here to the downside. Supply chain and chip shortages, it's not news. It's not new information. It's just information that is likely going to take a longer time to work its way into the price. So I think this is better for selling a call credit spread, similar to what we're doing in Fastly. And then lastly, another name here, Take-Two Interactive. We also have seen mobile gaming, significant slowdown in mobile gaming here. So Take-Two, after breaking above this $180 level, broke down below it, tried to break back above it, but failed again here. Failed at that 180 level and failed at the 200-day moving average. So I think Take-Two is likely headed down to the 160 and as potentially as low as 155 here to the downside, and kind of completing what looks like a fairly sizable head and shoulders formation here if you look at this on a weekly chart. And then long term, if it breaks below this head and shoulders formation, potentially back down to 110 or so pre-pandemic levels, which I think for a lot of the gaming stocks have at risk of this, whether you're looking at EA, whether you're looking at Take-Two, or whether you're looking at some of the smaller players like Zynga, Split2, some of these other mobile gaming companies. We have seen some substantial slowdown, basically a reverse of the reopening play, if you will, of those types of stocks and those types of revenues. And that's why I think this is the time to start looking for some bearish opportunities in those types of names. So with that, that covers what I wanted to share with you here today. Like I said, this marks a fairly substantial shift in terms of how things are currently being priced in the equity markets. And this provides a different opportunity here for traders. For investors, stay in the more value-based names. Be aware of what you're positioning in. Stay away from the higher beta tech names. This is not the time for those types of stocks. I do think that if you get more of a pullback, if we get more of a consolidation, you could potentially start looking at some of those stocks, but right now is not that time. Stay in those value-based names. And for the high beta names, you do have some opportunities with the reopening, with the slowdown of manufacturing, of potentially seeing some pullback here, some moves here to the downside. And for those of you that like to be more opportunistic, some bearish opportunities are presenting itself here in the broader markets here today. So with that, thank you so much. I hope you guys have a great trading day. And I want to thank our members for supporting us and allowing us to continue to doing this every single week. If you are currently on a free trial and you're thinking about becoming a member, you can sign up using the link here on your screen. That'll give you access to our weekly options education sessions as well on Thursday. And this Friday, I'm doing a rapid fire session. This is where you as members will submit your symbols and I will take a look at your charts, your symbols, and fundamental analysis and provide you my views on the symbols that you want to view. So for those of you that are members, I welcome you to submit your symbols here this week so that we can get them all together and make sure that I do analysis on those sessions. Thank you so much and have a great trading day.